Hi everyone, this is Dimitri Pergamonic with MarketChameleon.com. In this video, I wanted to show you how to set up a ratio call spread, or sometimes it's referred to a backspread. And right now, I'm going to set this up so you see how the payoff diagram looks at expiration, so you see what the outlook is like and why you would want to put on this type of spread based on where you think the stock is going. So here I'm just using SPY as an example. I went to the options chain. I'm going to set this up where I want to collect credit on the initial trade. I'm going to start out with the at the money call. So I'm selling an at the money call here. I clicked on the bid. Right now it's bid $2.03 on a 300 strike. So you could see here that's what popped up here, selling the October 30 300 call for $2.03. Now, since I want to collect money, I'm going to buy two upside calls, but I want to buy them for a price where, I still collect the credit on the trade. I'm going to go up here and I see this one, the 302.5 call right now. It's offered at 83 cents. So I'm going to click on that on the offer. It pops up as a buy. And I'm going to do, it's a ratio spread, so I'm going to buy two of these. I changed this to buy two for 83 cents. So now you could see here, I'm selling one at the money call, buying two out of the money calls. I'm going to run this strategy, load strategy, so you could see what it looks like at expiration. That's the payoff diagram. So you could see here, right now, I would collect 37 cents in credit. Midpoint is 40 cents here, so just keep that in mind because this lets you know how far away it is from the midpoint. You always want to try to execute your trades as close as you can to the midpoint because that's kind of like the market fair value at that moment. Now let's just look at this graph over here. So we see there are a different range of prices where this trade would be profitable. Now, if the stock just sits here or drifts lower, you could see you basically collect that credit and that's where you profit from. So as long as that stock expires below this lower strike of 300 that we set over here, that the money, as long as it's below there, then you just collect that 37 cents. So that's your outlook kind of to the downside or where the stock is here. Of course, if it just drifts lower a little bit, here at our right to the long strike, that's your max loss if it just drifts right to the long strike and stops. But at the same time, if you feel that if the stock goes up and the potential upside could be explosive, for example, like a biotech stock, or maybe the market sold off very heavily and you think like either we're going to sit here or bounce back really hard. But if you think that the scenario is that we're either going to sit here, drift lower, or the upside potential could be explosive, then this is where you start really making your gains. Once it crosses here, you see that your upside potential is unlimited, just like buying a call. Except, see, instead of buying a call, the payoff diagram will look much different, to the downside, or if it sits there, then you just lose the premium. Here, it looks a little bit different, because now you have a wider range of prices where you could potentially profit from this ratio spread. Now, another thing you might want to look at, well, if you do this, how did this strategy perform historically? This type of strategy, basically, if you sold at the monies, bought the out of the money strike, same distance away, with this ratio, how did it do historically? And that's what we already automatically have that theoretical value. So let's change it actually to 6 years of data. I'm going to reload it. So here what it's telling us is right now you'd collect 37 cents if you sold it on a bid. That's the credit. Historically, if you did this strategy over and over and over in the last 6 years, the end value was 8 cents. So now you're getting paid a little bit more than the average historical end value, and that's where your edge comes in at 29 cents. And if you did this in the last 6 years, your win rate was 59.8%. In other words, 59.8% of the time that strategy resulted in a profit at expiration. So better than 50-50 here. And that's how you would use the historical price return distributions and theoretical values to do a quick check here. So I'm going to come back here. Again, this is a ratio spread, selling one call, buying two out of the money calls. I set it up that it would receive a credit here, 37 cents. And to the upside, you could see once you cross over break even, then your upside potential is unlimited. Thanks everyone for watching. Hope to see you in the next video.